Markets have become increasingly complex for investors, making portfolio diversification and risk management more important than ever. Today, we're going to explore the evolving role of liquid alternatives, how the category is growing, and touch on the newer solutions emerging within the space. Joining me today are Rory Poole, Director of Alternatives, and Brandon Sims, Alternative Strategist at Fidelity Investments Canada. Rory, Brandon, thank you for joining me today.
Thanks for having us, Lauren.
Happy to be here.
Of course. So, Rory, why don't we start our discussion with you today? As mentioned in the intro, investors over the past quite a few years have had a very interesting experience through investing with higher rates, concentrated market leadership, and heightened volatility. Curious what impact this has had on the modern portfolio from your perspective.
Yeah, it certainly had a number of different impacts on the various different types of portfolios that are out there. But if I were to, distill it down a little bit, I think it depends on from, what angle you're thinking about not only your portfolio, but the market's impact on that in particular. If you're thinking about it solely from a return standpoint, i.e. you're someone in the short term that's very fixated on, how much am I earning in my investment portfolio, then I think what we've endured, particularly over the recent past, it breeds a little bit of impatience, if you will. There's been a large dispersion of return. And so what I mean by that is, the worst performing, whether it's asset class, sector, theme within the market relative to the best performing theme, asset class, security, you name it, it's been a large difference between the two. So as a result of that, you have a tendency, or investors out there have a tendency to want to make dramatic shifts in order to potentially capture some of that return. So some examples of that we've seen over the last little while is, fixed income isn't as attractive as equity, and therefore I'm going to move all my fixed income into equity. Or AI or gold have been, these popular topics over the past year or so. So, let's take, my real estate and, my industrials exposure and my financials exposure, and let's, put it all into those areas. And, I think that there's some risk in doing that. I'm all for, changes on the margin for investors over time, but, dramatic full-scale shifts like that typically doesn't work out over the long term for many investors. On the flip side of those that are fixated on return, I think that other people look at this more from a risk perspective. And what I mean by that is they look at some of those risks that you mentioned, whether it is, very strong performance within equity markets, whether it's interest rates that have been rising, whether it's the worry of inflation, you name it. And they try and take a step back and think to themselves, okay, is this something that will remain in perpetuity, or will it continue to exist in the near to medium future? Mm-hmm. Or is it something that, I don't necessarily need to worry about right now? And going back to what I said before, are there, marginal changes within my portfolio that I need to make in order to combat those potential risks?
Mm-hmm. Thank you, Rory. It sounds a little bit more like a slow and steady wins the race approach, which is great. So Brandon, could we pivot over to you and dive into liquid alternatives and perhaps what role you've seen these fit into investor portfolios navigating the market environment we set out, and maybe to Roy's point about making small, minute changes if liquid alternatives could be an option there?
Yeah, so I think small, minute changes is a great way to approach it. And I think what Rory was referring to was definitely a methodically devised, fully diversified portfolio. And I think that if you ask a population of investors, you'd see many hands raised if you ask the question, upon a shock, does most or all of the components of your portfolio move in the same direction at the same time? You'd see a lot of hands being raised. And I think that the goal of introducing fixed income or bonds broadly to an all-encompassed portfolio would be to balance or provide sort of a counterbalance to some of the volatility that you have on the equity side. And to your point about fixed income sort of having been a challenging asset class over the past number of quarters and calendar years, it's factual at this point. We can't control what the future ahead will provide, but I think that as investors look to make those minute at the margin changes, it is an introduction to alternatives. And we are seeing that being funded oftentimes, not always, but oftentimes from the fixed income side of a portfolio. And we would see something that combines each equities in a long capacity, bonds in a long capacity, and alternatives. Those alternatives under the hood can use equities, can use bonds, can be long short, can use other sort of instruments to provide unique exposures. And to the point about materials and or chasing gold, the last thing we want to do in investing is chase. I don't think it gets to a great place. Trend following is different, but chasing is certainly not something we want to do. We do want to make changes at the margin, and we want to stick to a long-term methodical allocation that will sort of mold and bend over time, but we're not going to be making sharp turns on a dime to turn our approach around just because something in the world changed around us. I think that it is really important that you have exposure to AI, that you have exposure to some more stable components in the portfolio that can be achieved through long bonds. But we just want to be careful to not have too much exposure and or exposure to interest rate sensitivity, which is something that we might touch on in a little bit. There's some very interesting things that you can do within alternatives. It's a growing space. There's a ton of innovation. And you're able to get more niche prescribed outcomes through using some of these tools that are available at your disposal in alternatives.
Thank you, Brandon. That's helpful and a really good reminder to our listeners to avoid really chasing headlines or jumping in there. So something Brandon did just touch on the emergence of liquid alternatives and them gaining popularity. Rory, could you touch on really what you believe is driving this momentum amongst advisors and investors with alternatives and what they're looking for in this space?
Sure. I think what's driving this affinity, if you will, for liquid alternatives nowadays is there's a lot more proof points that investors have. These products have been around for the better part of about 7 to 8 years. And with the emergence of new types of strategies and going through the ups and downs of a market cycle, as we'll continue to do in the future, there's more proof in the pudding in terms of the role that some of these products can play in someone's portfolio. So at a base level, it's kind of data. The second thing is the fact that, as Brendan kind of alluded to, and going back to your comments at the beginning, Lauren, we now have a lot of different types of tools that are available to the average investor that allow them to attack some of these key challenges or risks that are prevalent within today's market. So with that investor profile that I mentioned at the beginning, someone that's focused on making sure that they stay diversified over time, is cognizant of the risks or challenges that might permit them from achieving whatever financial goal they might have. There's a lot of different types of offerings that are out there and available for them. But I think, at a base level, the last part of your question, what are people looking for out of these liquid alternatives? It's tough. It's not a one size fits all by any means, which I think is a good thing. But I think that advisors and investors are just looking for, differentiation, in various shapes and forms.
For sure. Well, thank you for that. And you did touch on more variety and accessibility for investors as well. So Brandon, I wanted to ask you, of course, we've seen a lot of different types of alternatives come to market and different competitors or players entering the space as well. Could you touch on how this benefits the end investor?
Yeah, absolutely. We just launched 2 new products just last week with alternative bond as well as multi-alt balanced. And I think that that's just an extension of what we've been doing over the past 6 years or so, which is growing out and innovating our shelf. But other solution providers on the street, Canada-wide actually, are doing the same thing. So I do think that there's immense competition across the liquid alt universe. And with competition, I think the end result is a good thing for consumers or for investors. You get increased competition leading to greater product innovation. You have to do more to do better. And you're inevitably going to fill gaps in product lineups where there is investor demand, or at least that's what you're going to aim to do. Is we canvass the environment. We say, where are investors looking to allocate that maybe there isn't presently a solution? With that comes the opportunity for cost competition too. I think that as you're doing this, as products are scaling and as more people are doing the same thing, there is a degree where you do compete on innovation, but you also compete on price. So I think that at the end of the day, this competition is a great thing for the end investor. And we're seeing the space balloon by way of product count, as well as the breadth of offerings that are out there. We now have 10 liquid alternatives and 1 private solution in our lineup here at Fidelity.
As you mentioned, we did launch the Fidelity Multi-Alt Balanced Fund and the Fidelity Alternative Bond Fund. Rory, could you talk to us a little bit about these products and how they complement our existing lineup at Fidelity?
Sure. The products themselves, fill different needs and roles within investors' portfolios. Lauren, but maybe to simplify it for our listeners today, if I think a little bit about the different types of strategies we're trying to build for investors out there, I liken it a little bit to building a chess set for someone. So if you're familiar with chess at all, you've got all these various different types of pieces, pawns, rooks, bishops, kings, queens. They can all move in a different fashion around the board. Some only move forward, others can move forward and backwards. Some can move multiple spaces, others can only move a few spaces. But ultimately, it is, that collection or that set working together in order to help the player win. And to liken that back to an investor, and what we're trying to do with the alternatives lineup, we want to have different types of pieces available for investors to win at whatever their goal might be, but recognize that they all play their unique part in that process.
That's a great analogy. Thank you for sharing that. To get slightly more granular, Brendan, with these products we are introducing liquid alternative credit. Curious if you could provide a little bit of background to our investors as to why we got into that space and how it differs from traditional bonds in a portfolio.
Yeah, so we launched Fidelity Alternative Bond last week, and that's going to be absolutely in the long-short credit space. And I think that when it comes to investing both long and short in the bond space, there's a number of different things to consider that are not necessarily present in the equity space. But at the end of the day, it's not vastly different. We are using a long book and a short book in conjunction to combine our fixed income exposure into one resulting net portfolio. And I think that when you are short any financial instrument that has a coupon or even a dividend on the equity side of the fence, there can be a negative carry component of that where you actually owe that payment back to whom you borrow that fixed income security from. So at the end of the day, in these portfolios, there's many different things you can do, many different ways you can position the portfolio. But I would think that what you're able to do is you're able to create a more niche portfolio, whether that's sensitivities to interest rates, overall volatilities, where you're targeting across a number of different fixed income asset classes. So for example, if you're going to, say, play in high yield, that in and of itself encompasses a certain risk profile and or sensitivity to interest rates. Whereas if you are participating with a long-short approach, you can kind of counterbalance some of those exposures. And I think one other aspect within the alternative lens, if you would, is the ability to manage that interest rate exposure using other financial instruments. And we won't necessarily dive too deep into that, but there's a concept called duration, which is your sensitivity to changes in interest rates. And I think that on a product of this nature, for example, we can be as much as, again, using a bit of industry terminology, we can be 4.5 years to negative 2.5 years. And I think that ability to toggle and manage your exposure to interest rates through some of the tools that are at our disposal, through that of being a liquid alternative product, those are attractive and not necessarily available through long-only investing.
Very good. Well, that brings us to time today, but really appreciate both of you walking us through all of the changes happening in portfolio construction, liquid alternatives, and how Fidelity is bringing new solutions and strategies to investors in Canada. So thank you both very much.
Thank you.
And thank you all for watching today. At Fidelity Canada, we're releasing new content daily. So please look up the Upside or Fidelity Connects podcasts for on-demand videos. You can get an exclusive first look at Upside shows as a streamed webcast where you can learn to be a better investor and hear from some of Canada's best stock pickers and leading financial experts. To not miss a show, head to fidelity.ca and sign up for the next webcast or Upside newsletter. Thanks for watching today, and I hope you'll join us again. I'm Lauren Gardy.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants, and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.